And when we form a portfolio, we can remove one of those types of risk. Right? And we do so via something called diversification. Right? Now, diversification is specifically the act of investing in many different types of assets. Right? So a diversifying purchase is buying something that's different from what you already have. A diversified portfolio is a portfolio that contains lots and lots of different unique assets. Right? So portfolio diversification does not just mean buying lots of things. It means buying lots of different things. Right? So just because you have 50 internet stocks or 10 car stocks doesn't mean you're diversified. It just means you have a lot. Diversification means you have one internet stock and one hospital stock and one car manufacturing stock and one airline stock and one defense contracting stock across the board in as many different industries as you can. And that's not even as well diversified as we can get, because all that means is I am diversified across the stock market, and particularly all the ones I mentioned, the US stock market. But I can diversify even more significantly than that by buying bonds and stocks, or bonds and stocks and preferred shares, or options and volatility contracts and collateralized debt obligations and commodity futures and all kinds of other investment options and assets that we haven't talked about in this class, and you won't talk about unless you go take the investments course and learn more about different kinds of investments. But the point is, I should be trying to diversify across all kinds of different assets, and again, across all kinds of different investment strategies. And then not only that, I should be looking at doing all of that both on an international scale and a domestic scale. So I should be diversified within the US, but I also want to be diversified within the global economy. Because when we think about market risk, we recognize that markets are different, right? There is a market that is just the stock market in the US and a market that is just the bond market in the US. And so there is some systematic risks that only affect one or the other of those. However, they also affect the broader market that is the entire US economy. So something that affects everything in the stock market probably also affects the broader economy. But it's certainly possible that something that a market risk that only affects the US economy doesn't have as big an impact in other countries' economic cycles. Right? So you could have seen a major disaster in the US like Katrina, or a major disaster like, say, the Australian wildfires. Right? While they would have had a very significant impact in their home country, so Katrina had a huge impact on the US economy, the Australian wildfires had a huge impact on the Australian economy, they didn't have a simultaneously large impact on other countries in the world. Our economy was not really affected by the Australian wildfires. And Australia's economy probably wasn't that affected by Katrina. Although things that affect the US economy do tend to trickle out into the broader world economy because we're such a dominant economic power. Right? So we want to make sure that we are diversified even across bigger markets. Right? I can avoid some of the systematic risk in the US market by investing in, say, African markets or Asian markets or South American markets. Right? And I can simultaneously avoid being affected by systematic risks in those markets by being in European markets and Central Asian markets and South Asian markets. Okay? So, diversification, as you might now realize, is a pretty significant process. It involves a ton of work. It's not something that most individual investors can really do with the small amount of time that we have to manage our investment portfolios or our retirement portfolios. And so we, by and large, are going to rely on other people to do this kind of really advanced, proper diversification for us, just because it's so much time and effort. It's also a lot of expense. You will generate a lot of fees making all of these individual purchases of these individual assets. And it's not cheap to have one of every stock, or one out of two stocks and one out of two bonds, or buying stock in all the different asset classes and strategies and countries that I just talked about. So it's easier for us to buy into someone else's diversified portfolio. These are what gives rise to things like mutual funds. And again, this is not an investment class, so we won't really talk about that kind of thing, but just recognize that while diversification is a really worthy goal, it's also a lofty goal for an individual investor. And we should recognize that this is there, and we should recognize that we don't have a good ability to do it on our own, and take that into account when we make our retirement selections. Right? But the benefit of diversification is that it reduces our risk. Right? This is how forming a portfolio reduces risk. And it does so because when I combine all these different kinds of assets, all these different kinds of stocks and different kinds of stocks and bonds and real estate and commodities and in different countries, there is going to be an ability for all of those different combinations to offset the risks of each other. Right? So if something happens in the US market like Katrina, we have all these stocks in other countries and other markets that aren't affected, and so they don't have a down. Right? So the US stock market falls, and all my assets in the US market have a negative return, but all my assets in the other markets hopefully don't fall, or they don't fall as much, and they have a positive return maybe, and those two returns offset each other. And then if something bad happens there, something good happens here, and they offset. Or typically bonds and stock markets move in opposite directions, typically. So if the stock market is falling, the bond market is rising, and they're offsetting each other again. Right? So what happens when we form a portfolio is we diversify away all of the unique risks that are unique to the individual sectors or the individual companies or the individual industries. And we offset them with other diversified assets that aren't affected by those things. Right? So unique risk to Boeing might be that they have a plane crash. Right? Well, so if I want to be diversified against that, well, I can buy one of their competitors like Airbus. So now if Boeing crashes and then nobody wants to hold Boeing stock anymore, everybody will run to Airbus, and I'll have a positive gain in Airbus and a negative loss in Boeing, and they'll offset. Right? But that might affect the broader airline industry in general, and so maybe I buy another transportation stock like trains. Right? And then I say, okay, if people are too scared to fly anymore because of all these plane crashes, they'll instead take trips by train or car. And then I say, okay, well, maybe I'm worried about something like the unique risk or a more systematic risk like oil market. Right? What if the oil prices climb so high and travel in general gets really expensive? So instead, I have other stocks to offset that. Right? And so what I'm doing through diversification is trying to think about the types of assets that would offset the risks in the other assets that I already own. And that's what I mean by intelligent portfolio formation. We really have to think deeply about what kinds of risks offset each other, and what kinds of assets will provide this diversifying value and will actually reduce our risk. Again, if I just hold a ton of internet stocks, I haven't done anything. The same thing that affects one will affect the others. And so I haven't diversified, and that means I haven't done anything.